Welcome back to EDS, and in this video I'm going to show you how to manage your portfolio once you've got some positions on, and I'm going to show you the behind the scenes of what it looks like and what the realities are. So this is our portfolio. This is a very small portfolio, super small, and it's for example purposes. I know in every video I always say to keep things nice and diverse, and for the most part we are quite diverse in this portfolio. However, that's not the main aim. This is literally just for example purposes, and just to show you on a position level how to manage your portfolio as opposed to how to manage your portfolio on a portfolio level. So let's jump straight into it. We've got 1, 2, 3, 4, 5, 6 positions on at the moment. GDX, we've got Macy's, AVGO, Euro Futures, Canadian Dollar Futures, and NVO. So let's start at the top. We've got GDX. Basically, we're sitting at break even, 6% in profit. We've been in this position for 5 days, 47 days left on the contract. This is a very new position, so premature position. But we're going to go into GDX and have a look at the chart. So GDX, let's have a look. It is a strangle. It's not an iron condor. It is a strangle, and our strikes are at 31 and 38. So let's just plot those on the chart here, 31 and 38. 31 and then 38. I normally, in my actual portfolios, I don't mark anything on the chart. This is simply just to show you guys a visual representation of what the position looks like. But in your own portfolios, you don't actually need to put any lines on for your strikes or anything like that. But here we go. This is GDX. So we're currently trading at $35. It is a Sunday. The market's closed. Last traded at $35 a share. We have our short call up here at 38, and we have our short put down here at 31. Price is pretty much right in the middle of our range. There's absolutely nothing to do. You guys know the drill at this point. If our strikes haven't been breached, then we sit tight and we don't do anything. We just simply let the position work. Everything is going in our favor. Remember, when we put these positions on, we have over an 80% chance of success at the point of entry. So more often than not, it's just a case of waiting for our profit target to get hit. So nothing to do in GDX. Plenty of time left on the contract. Let's go into Macy's. Let's have a look. Macy's is also a strangle. We're basically again at break even. We've again been in this position for 5 days, 47 days left on the contract. Very young position. So let's pull up Macy's. We haven't got the lines plotted here. It is a strangle. Again, we've got our strikes at 15 and 20. Let's just plot that on real quick for you. 15 and 20. There we go. We have our short put at 15 and our short call at 20. So this is what the position looks like for Macy's. Macy's has been moving sideways since about July, August time. Pretty wide range here. It last traded at $16.82. We're again right in the middle of the range. Nothing to do here except wait for price. Wait for the Greeks to do what they need to do. Wait for volatility to come out of the contracts. Wait for theta to decay the value of the contracts, and we'll be looking to get out at a nice profit. Again, with Macy's, nothing to do here, and this is what it looks like when you're writing contracts that are 45, 60 days out in time. The main thing that you're going to need to do is just be patient. Once you've put the position on, let the position work. Don't get caught up into making tiny adjustments every time something, every time your deltas change a little bit here and there. I mean, if you look at our net deltas here, nothing's really out of proportion except for the stuff that's in the money, but we're going to talk about those separately. All the new positions that we've put on that are not in the money, our deltas are pretty pretty standard. There's nothing really to worry about here. You only really need to worry about your deltas if it's a naked position. If you've got a covered position, you don't really need to worry about your deltas too much because your position is covered, so your risk is defined. You can still manage defined risk positions like iron condors, which is what AVGO is. But if you wanted to just put it on and forget about it, you absolutely could do that, and you'd be perfectly fine. Only for covered positions, not naked positions. But I digress. Let's go into AVGO. AVGO is an iron condor. Again, we're basically sitting at break even. 3 days into the contract, 47 days left. Again, very, very new position. We have our short strikes at 210 and 270. We have got those marked. Oh, no, we don't have those marked. Sorry, that was the wrong chart. So 210 and 270. Let's just mark those on real quick so you could see. 210 and 270. So AVGO is an iron condor, and we're just going to mark the short legs instead of the as opposed to do the long legs as well. The long legs are just $5 out from the short legs, so feel free to extrapolate that. But basically, the short legs is where our risk is, so that's why we've marked that on the chart here. So it last traded for $232.55, which again is right in the middle of our range. There really is nothing to do here on AVGO except for just wait, and again let the position work in our favor. Everything is going to plan, and there is absolutely nothing to worry about with AVGO. We've only been in the position for 3 days. We just need to wait and be patient, and then we'll be looking to take profit over the next week or two. So now we get to the sticky stuff, which is the Euro futures, Canadian dollar futures, and MVO. So we're in the money on all three of these, but let's take a deeper dive. So the Euro futures, we've got we've been in this position for 31 days, 33 days left, so we're coming up to about the halfway point. It is an iron condor, so we're not really too worried. Anytime we got a defined risk, you're not worried because it's just a simple case of getting as many positions on as you can. Your risk is defined. You know what your profit is at the beginning. You know what your risk is at the beginning, and it's just a case of rolling the dice as many times as you possibly can. Most of the time it'll work. Sometimes it won't. Over the long run, you'll make money, and that's basically the game with defined risk positions. So the Euro futures is an iron condor. We are in the money on the put side. Only on the short leg, not the long leg, so price hasn't moved too far against us. Let's take a look on the chart. So this is what the Euro futures looks like, and as you can see, price did breach our short strike, our short put. However, price did recover over the last trading day, and we are, even though price has breached our short leg, remember we collect a premium up front, so our break even is actually further below. So at this point here, with it trading at 1.03335, we would still actually make money if price expired exactly where price, if the contract expired with price being where it is right now, we would still make money on this position. Remember, we're collecting the premium, we're not paying the premium, so the premium gets added on. Well, in this case, with the short put, it actually gets taken off. Whatever the premium is that we collect gets taken off the price that we sell the strike that we sell the contract at, and on the call side, it would get added on. So basically, our break-even points are wider than what our strikes are at, if that makes sense. So with it, in the case of the Euro futures, we simply just need to wait because this is a defined risk position. So if this was a naked position, we'd be looking to make some adjustments and move the call side down here, collect some more premium, and bump up our total premium on the position to extend our break-even points wider and wider. But in this case, there really is no need to do that. I mean, we could do that. Come Monday, we might look to mock up a little position. We'll see how the market opens, but we might look to make a small adjustment, moving down to around the 1.08 level on the call side. We might even go a little bit further down to the 1.06, but it really is unnecessary. Every time you do make an adjustment like that for a defined risk position, you are lowering your probabilities of success in exchange for lowering your risk. So you lower your probability of success, but you also lower your risk because you're collecting more premium. So in this instance, we probably won't do anything. Price really is kind of just at our strike anyway. There's not really too much to be worrying about. There's still a lot of time, over a month left on this contract, so we're basically just going to see what price does, what the Euro futures does over the next couple of weeks, and we'll look to exit the position and take some profit off the table. So let's go over to the Canadian dollar futures. So the Canadian dollar futures has moved a little bit further against us. We've got both puts in the money. We've been in this position for 37 days. We've got 33 days still left on the contract, and this is what the situation is for the Canadian dollar futures. So if we have a look, this is a iron condor, meaning it's a defined risk position, not a naked position. So the analysis is going to be pretty similar to the euro dollar futures. As you can see here, price has breached our strike, and it seems to be consolidating here. We'll have to see which way price moves, whether it ends up being further lower or whether it ends up being higher. Obviously, we would want it to be higher, but if it does go lower, it's fine because our risk is defined. Our max loss is defined on entry. This is the power of defined risk positions. Not to say that defined risk positions are better than naked positions. It just depends. They're basically the same thing, but they're different. Their risk profiles are different, but all in all, it's essentially the same thing, really. Anytime you're selling contracts, it's all the same stuff. The market is very efficient. I believe the market is very efficient. So anytime you're getting something up front, you're giving something somewhere else. So it's all the same stuff, really. But anyway, so Canadian dollar futures, again, we're just going to basically see what price does. If price moves further against us, it's completely fine. If price recovers, excellent, and we'll look to take profit. Remember, the risk is defined on entry. So in the worst case scenario, we take the position off and we just open another one, and we just let the odds play out. With naked positions, you can work the position a bit better. You can work a losing position into a break even or even a winner over time, but with a defined risk position, you don't really get the opportunity to do that too often. And the trade-off with that is, with a defined risk position, you know your risk on entry. With a naked position, you have an unlimited loss potential, which is why, although an unlimited loss potential might be scary, you won't take an unlimited loss as long as you know how to manage risk. And oftentimes, it's actually easier to manage naked positions, for the simple fact that you have a lot more maneuverability. They're a lot more malleable. Defined risk positions is very rigid. Your longs covering your shorts are sort of like anchors weighing you down, and you can't really move stuff around too easily. So that's the trade-off, really. And in this instance, well, in any instance, you have to play whatever the pros are for the position. If this was a naked position, we 100% would have rolled down the untested side, which is the call contract. However, because this is a defined risk position, we just have to play to the strengths of defined risk positions, which is being able to just let it run. Quite often, price will breach your strike, and typically, whatever your delta is of that contract, the chance of price touching that strike is typically about double whatever the delta is. So if you're selling, so let's say we sold this short put and it was a 20 delta when we got filled, well, there's roughly about 40% chance that price will touch that strike at some point in the trade. Although there's only around about 20% chance of it being in the money at expiration. So with that knowledge, this will happen sometimes, and sometimes price will stay out of the money, sometimes price will sometimes price will stay in the money, and sometimes price will go back to being out of the money, which is what we want. So with that being said, this is just a waiting game for the Canadian dollar. Let's move over to NVO. NVO again is an iron condor. This is a little bit interesting because there was an announcement. NVO, they did some trials or something like that, and basically didn't go too well. So overnight, the price just completely dropped. It dropped too fast for us to be able to actually make any adjustments. However, it is a defined risk position. It's an iron condor, so there's no need to actually make any adjustments. So price opened, much lower than where our short put is. So we are in the money on both the short put and the long put. This is a $5 wide iron condor. So our short strike is at 95 and our long strike is here at 90. So we are sitting just below where our long strike is. Again, let's see how much time we have left on the contract. We've got 12 days left on the contract. This is going to be a case of where price is either going to just stay in the money, or it will rebound and come back to being out of the money a little bit, with respect to our short strikes, not our long strikes. So again, NVO is just a waiting game. If this was a naked position, we 100% would roll this down. We'll wait to see how the market opens on Monday. If we don't believe that price will recover in time, because there is only 12 days left on the contract, then what we could do is roll down the call spread, or the call side, down to around the 110, 112 level, just to collect some more premium. We're not actually trying to win the trade at that point. It's just damage control. If you're, let's say for example, if your max loss on this position was say $300, and we can collect another say $50, $100, and we can bring that max loss down to say $200, $250, well, in my book, that's a win, because if we were originally going to settle for $300 loss, but we can reduce that down by a third, say, then that's a win, because the selling premium, the edge is built in, because implied volatility is pretty much almost always overstated in the market. So the edge is built in when you sell contracts. So even if you do have losing positions, as long as you have more capital to sell more positions, that's the aim of the game here. You want to stay in business like a casino, like an insurance company. That's the business model that we're going for. You want to be able to stay in business and sell more, and let the odds work out over time. However, in the interim, for every one position that you lose, or for every losing position, if you can reduce your loss by a third, or by half, or even by 10%, that's going to go a long way, because your winners are going to take care of themselves. So we'll see what the market does come open on Monday, and we will potentially look to roll the call side down, collect some more premium, and see if we can mitigate our losses as much as possible, or potentially even go back to break even, or turn a profit on this position. Now you might be wondering, out of all of the positions here, why are most of them red? Well, because when you're managing positions, this is an important thing to note. It's like a conveyor belt, okay? So typically what will happen is, the positions that work well, you'll take them off when they hit their profit targets, right? You take them off, and then what will happen is you'll reload that capital, put on new positions, like for example we have done here with GDX, Macy's, and AVGO. So we've reloaded. As you can see, we've only been in these positions for a couple of days. So we take off winning positions and we reload that capital and put it back into new positions, to always keep your money working. And so what will happen is, the positions that win, and then the positions that don't will end up typically being left in your portfolio. And if it's a defined, if it's defined risk, then you're basically just waiting to see what happens. If it's undefined risk, i.e., if it's a naked position, then you'll be working those positions back to a break even or a slight profit, and then you'll be able to get out of them. So essentially, the reason why it looks like this is because we've had some positions that worked really well, but we've already taken them off. So if we look in our Discord, we've taken off a GLD position that came in. We've taken off an Iron Condor on Tesla that came in, on Palantir that came in. We had a 0 day on SPX that came in. So we've had positions, as you know, like I've said, like a conveyor belt. We've had lots of positions that have come in. We've taken them off. So what we're left with now are either the positions that didn't go our way, or new positions that we've reloaded capital with. And that's exactly what our portfolio is right now, and that's because it's a small portfolio. The more money you have, the easier this is to do. So that's basically what it looks like. So it's very easy to get filled. It's very easy to, you know, pick some deltas, pick some strikes, sell some contracts, collect some premium. That's the easy bit. Managing your positions, and, you know, even managing winning positions, that's easy. You know, as you saw, we took off 3-4 positions this week that came in. What we're left with now is positions that we've reloaded our capital with, and the positions that didn't go our way. And the skill and the intuition and the experience comes in when you are managing your losing positions. So the reason why I went with strangles on the new positions with GDX and Macy's, AVGO, because it's a larger underlying, we had to go with an Iron Condor because of the size of this portfolio. But with GDX and Macy's, I specifically made sure to go undefined risk, because I want to also be able to show you guys how to manage positions that move against you when you are looking at an unlimited loss potential, because that's where the real game is. That's where we earn our money. Because as I mentioned with MVO, you know, if you can reduce your loss by a little bit for your losing positions, that's going to go a long way. You know, if you've got an 80% success rate up front, you know you're going to win 80% of the time. That means you know you're going to lose 20% of the time, right? And in those 20% of times that you lose, if you can work half of those positions back to a break even, that's gonna completely boost your overall profitability massively. And you know, you can only really do that kind of stuff with naked, unlimited loss potential positions, or undefined risk positions. And so that's why I specifically went with the strangles on GDX and Macy's. So hopefully we'll get some opportunities to show you that as well. But just remember, keep your cool. This is a long game. Let the Greeks work in your favor, and make sure you always keep your position sizes small enough to where you can stay in business. That's the key here, because short-term variance can sting anyone. You can get lucky short-term as well, it happens, but it also happens where you can get stung short-term. And the game here is to stay in business and increase your number of occurrences. And as long as you focus on that, you know, the edge will take care of itself. Like I say, the edge is built in to what we do. So your job is not to find an edge. Your job is to stay in business. So how do you know how much buying power to allocate to your positions? We've created a free position sizing template that's available for everyone to use and get a copy of. Link will be in the description. All you need to do is click on this button here, and it will take you over to this spreadsheet. You enter in the size of your portfolio, you enter in what the current VIX level is, and it will calculate everything for you. It will tell you how much buying power you should be allocating to your positions based on whether they're defined risk, undefined risk. It takes all variables into account. And the link for that will be in the description. Also, if you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, etc. There's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know. It's a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. There's also a 100% money-back guarantee, so once you have studied our full course and followed our trades for at least 6 months, if at that point you're not profitable, then we will work with you for free until you are, or you can simply just request a full refund. So it's completely risk-free, and it's £1 a month to join. The price is so cheap because we've just launched. The price will be increasing, however. Once you're in, the price is locked in for you for life, so you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill of being able to write contracts, manage your positions, and generate consistent returns over time. And it's something that once you learn, no one can ever take it away from you, no matter what. It's knowledge. So our aim is to get you to that point within 6 to 12 months. So with that being said, you're always welcome to stay and be a part of the community. However, 6 to 12 months, you should be good to go. So I'll see you guys on the inside.